In just 72 hours, 27% of the value of silver completely vanished. Billions of dollars in wealth wiped out in the blink of an eye. The mainstream financial media immediately blamed a warning from the new Federal Reserve Chair, but the real trigger was a quiet, overnight rule change designed specifically to trap retail investors and protect the massive bullion banks. Hello everyone, I am John Agg, and welcome back to the Wealth Reactor. Today, we are cutting through the market noise. We are going to deconstruct the exact anatomy of the recent silver flash crash. If you are holding physical silver or trading precious metals, you have likely seen the terrifying headlines and the sea of red on your trading screens. But what actually happened was not a sudden drop in global industrial demand. It was a masterclass in market mechanics. It was a perfect storm of macroeconomic fear, combined with a targeted, lethal strike on leveraged retail traders by the Chicago Mercantile Exchange. This is the absolute truth behind the 2026 silver collapse. Let us break it down. To understand how the floor fell out, you first have to understand the staggering heights we recently reached. Going into this year, silver was the undisputed leader of the entire commodity supercycle. The fundamental data was historically strong and completely undeniable. For 5 consecutive years, the world consumed significantly more silver than the global mining sector pulled out of the ground. Driven by the massive green energy transition, the construction of new solar panel gigafactories, the push for electric vehicles, and the absolutely explosive growth of advanced artificial intelligence data centers, industrial demand created a severe structural supply deficit. Retail investors saw this data and rushed in. The market sentiment shifted from cautious optimism to absolute, unchecked euphoria. Everyday traders began piling into paper silver futures contracts using massive amounts of leverage to multiply their gains. They were betting the house on triple-digit silver. But in the highly manipulated financial markets, when everyone is crowded on one side of the boat, a single engineered wave can capsize it. To understand exactly how this trap was sprung, we actually need to look backwards. This is not the first time the institutions have changed the rules in the middle of the game to crush a silver rally. If you study market history, you will remember the infamous Hunt brothers in the year 1980. The Hunt brothers had legitimately cornered the physical silver market, driving the price up to nearly $50 an ounce. The establishment was absolutely terrified. So what did the commodity exchanges do? They did not let the free market play out. Instead, they completely changed the rules. They created something called Silver Rule 7, which suspended all new purchases of silver and only allowed traders to sell. They also drastically raised margin requirements, forcing massive liquidations. The price of silver collapsed. The establishment saved themselves by actively destroying the retail participants. What we just witnessed this week is the exact same institutional playbook, modernized for the algorithmic era. The first psychological blow originated in Washington. When the administration nominated Kevin Warsh as the new chair of the Federal Reserve, the fundamental rules of the macroeconomy shifted overnight. Warsh is notoriously hawkish. He is a strict sound money advocate who has historically criticized the massive bloated balance sheet of the Federal Reserve. The market instantly priced in a terrifying new reality. The era of easy, limitless liquidity and zero interest rate policy was officially over. The reaction across the financial landscape was violent. The United States dollar index spiked massively and Treasury yields surged higher. Because commodities like silver and gold are globally priced in dollars, a significantly stronger dollar makes those metals much more expensive for foreign buyers, which temporarily suppresses global demand. The rumors began to swirl that Chairman Warsh was preparing to actively regulate and crush speculative assets. Absolute fear flooded the market. But fear alone only pushes prices down incrementally. It does not cause a 27% free fall in 3 days. For that level of complete destruction, you need forced, involuntary liquidations. While the mainstream financial media focused their cameras entirely on the Federal Reserve and interest rates, the actual execution took place in the paper derivative markets, specifically at the Chicago Mercantile Exchange. To trade a paper silver futures contract, you do not pay the full price of the metal up front. You put down a small fractional deposit called margin. In the middle of the Federal Reserve-induced panic, the exchange quietly deployed its ultimate weapon. They raised the initial margin requirements for silver contracts by nearly 50% overnight. Think about what that mathematically means for the average investor. Imagine you are a retail trader holding a massive paper silver position. You have a minimum amount of cash backing it up in your brokerage account. Suddenly, you get a notification on your phone. The exchange just changed the fundamental rules of your contract right in the middle of the trade. You now have just a few short hours, and in some cases only minutes, to wire thousands of additional dollars into your trading account just to keep your position open. This is the dreaded margin call. If you do not have the spare cash sitting around, you have absolutely zero control over what happens next. The automated algorithms of your broker instantly step in and sell your paper silver at the current market price, no questions asked, locking in your massive losses. This triggered exactly what Wall Street institutions call a liquidation cascade. As the first massive wave of undercapitalized retail traders were forcefully liquidated by the exchange, the sudden influx of panic sell orders drove the spot price of silver down even further. That sudden downward price drop then pushed a second, larger wave of traders below their new margin limits, triggering even more automated selling. Then, the crash hit the technical stop-loss orders. As the price of silver plummeted through major psychological support levels on the charts, massive high-frequency institutional trading algorithms woke up. These computer programs, which can execute thousands of trades per second, recognized the vulnerability in the market and began shorting silver aggressively, pouring absolute gasoline on the fire. The Federal Reserve provided the initial psychological spark, but the massive margin hike was the explosive powder. It was a structural, perfectly engineered flushout designed to completely eradicate over-leveraged retail traders and reset the board for the large banks. But here is the most critical piece of the puzzle that the financial news networks will never tell you. We must look at the massive disconnect between the paper illusion and physical reality. While the spot price of silver was crashing by 27% on the digital screens, the actual physical market completely ignored it. If you tried to go to a local coin dealer or a major online bullion distributor during this crash to buy cheap silver, you quickly realized a terrifying truth. The physical metal was not actually discounted by 27%. As the paper price collapsed, the physical premiums exploded higher. The dealers simply raised their markup to compensate for the artificial drop in the paper price, because they know exactly how rare the physical metal actually is. Meanwhile, the actual physical silver sitting in private vaults around the world did not change a single bit. The industrial demand from the tech sector did not stop, but the paper derivative market was absolutely decimated. So, how do we navigate this extreme volatility at the wealth reactor? We survive by separating the signal from the noise. First, you must fundamentally understand that paper derivative markets and physical asset markets are two entirely different games. The industrial demand for physical silver has not vanished, and the global supply deficit is getting worse every single day. Second, this engineered flash crash is a brutal, expensive reminder of the extreme dangers of leverage. When you trade paper silver on margin, you are playing a dangerous game inside a rigged casino, where the house can legally change the rules while the roulette wheel is still spinning. If you own pure physical sovereign bullion in your own personal possession, completely outside of the banking system, this price drop is nothing more than a temporary paper illusion. It does not impact your true wealth. In fact, if you are currently looking to enter the precious metals market or add more weight to your stack, a 27% mathematical correction often provides the exact entry point that smart institutional money looks for, right after the weak retail hands have been completely washed out of the system. They engineer the panic so they can buy the physical asset on the cheap. Do not let them take your wealth. Thank you so much for watching this urgent macroeconomic breakdown. It is critical that we get this data out to as many people as possible before the institutions lock the doors. If you want more high-level, no-nonsense financial analysis that actually protects and grows your capital, hit that subscribe button right now. Smash the like button to defeat the algorithmic suppression, and turn on the bell icon so you are notified the second our next alert goes live. Let me know in the comments below if you held strong during this flash crash, or if you used it as an opportunity to stack more physical metal. I am John Ogg, and until next time, keep your wealth reacting, trust the physical data, and stay ahead of the curve.